In this video, I want to look at the factors behind Warren Buffett's investment success. Here, let's take a peek at a research paper by Frazzini, Kabiller and Pedersen. Its authors used a rigorous empirical analysis to explain Buffett's alpha. I will also discuss implications of this paper for us, small investors. So let's delve in. In 1984, Warren Buffett published a famous article at Columbia Business School. It bears the famous name of the Superinvestors of Graham-and-Doddsville. There he attributed much of his success to value investing. Further, Buffett challenged the idea that equity markets are efficient. His focus was on 9 successful investment funds managed by Benjamin Graham's alumni. These fund managers generated long-term returns way above the market. What's more, their outperformance was not only in stocks but also in other asset classes. As Buffett pointed out, this could not be some coincidence or fluke. Warren Buffett reiterated the importance of having knowledge to enable you to make a very general estimate about the value of the underlying businesses, but you do not cut it close. That is what Ben Graham meant by having a margin of safety. So, while many debate Buffett's success, surprisingly there's little research on it. Many academicians either ignored or completely wrote off Buffett as some sort of fluke, and of course their argument hinges on the market efficiency hypothesis. It says that asset prices reflect all available information, and it's impossible to beat the market consistently on a risk-adjusted basis. In other words, higher returns would mean taking on higher risk of losses, and vice versa. So, in theory, market prices will only react to new information. But it's laughable to explain Buffett's success as a coin flip. The research paper by Frazzini and others looked at 41 years of trading history. A dollar invested in Berkshire Hathaway in 1976 would be worth $3,685 in 2017. Over the same period, Berkshire showed an average annual return of 18.6% above the Treasury bill rate. For comparison, the stock market excess return was 7.5%, which is more than 2 times smaller. At the same time, the Sharpe ratio for Berkshire Hathaway was 0.79 compared to 0.49 for the market. But don't get an idea that Buffett's performance was all roses and rainbows. From 1998 to 2000, Berkshire lost 44% of its market value, while the market rallied by 32%. Very few fund managers could have survived such a 76% shortfall. But when the dot-com bubble burst in 2000, Buffett looked like a genius and was revered like an investment god. The authors of this research paper identified several factors behind this staggering success, and one of them is the use of leverage. That's right. Berkshire Hathaway is a leveraged business thanks to its insurance operations. When people buy insurance for their home, car, or other property, they pay premiums, right? But did you know that insurance companies rarely pay out these premiums in a given year? Instead, this money tends to sit in their coffers, waiting for a disaster to strike. This idle money is something called an insurance float. Insurance companies invest these funds in stocks, bonds, and other assets. And this is how many insurers make money. Exactly the same model applies to Berkshire Hathaway. Their insurance arm has given them large amounts of capital and leverage for years. I made a video where I took a deep dive into the role of insurance floats behind Buffett investment success. I linked it above. The authors of this paper estimated that the Berkshire Hathaway leverage is about 1.7 to 1. In other words, if Berkshire earned about 10% without leverage, it would be 17%. And the leverage also had a negative consequences for Berkshire. It amplified bad years of performance and made its stock quite volatile in those years. And this is despite Buffett investing mostly in stable businesses. What's interesting is that this insurance float cost little or nothing for Berkshire. For the past 20 years, its insurance operations have been profitable. In other words, Buffett got paid to have this capital that he has been leveraging for years. Besides insurance float, Buffett also uses leverage from its tax-deferred liabilities. As you may know, Berkshire invests in many other businesses, not only insurance, things like energy or railroads. and they often write off their capital expenditures immediately in the same year for tax purposes. Conversely, financial accounting requires firms to depreciate this property over a certain number of years. This fast depreciation for tax books is like an interest-free loan from the IRS. In other words, Berkshire enjoys early tax savings, and the dollar it owes to the IRS is the same as it is years from now. In 2023, Berkshire reported $33 billion in deferred tax liabilities for its property. For comparison, Berkshire's total assets were roughly $1.1 trillion. While small, this deferred tax liability still adds up to Buffett's leverage. Finally, Buffett sometimes sells derivative contracts, and this is especially true for put options on major stock market indices. By doing so, he generates capital from his premiums. Though Buffett doesn't sell that very often, and typically on a smaller scale and only when the odds are in his favor. As you may know, the selling put options is a bullish move, though it can expose investors to large losses if there's a major price decline. So what kind of implications does this all have, especially for small investors? Well, I don't think we can go and replicate Buffett's leverage in a low-cost way, that's for sure. Still, the leverage can be beneficial. I'm not saying we should run and borrow our brokerage margin account to its capacity. I always remember that leverage is the two-edged sword that can amplify both gains and losses. Another problem with retail leverage, especially on margin, is this. Not only is it expensive, but also recallable. If stocks tank, your broker will make a margin call. Or worse, he can liquidate your positions prematurely. For Buffett, the story is different. His only major recall can come from disasters happening. Only in that case that Berkshire must make large insurance claim payments. Buffett pointed out that on average they pay out roughly 3% of their insurance float every year. As we see, this leaves him with a lot of idle capital to deploy in the meantime. Overall, if an investor knows what he is doing, leverage can definitely help. And this can partly explain why leveraged ETFs and stock options are becoming so popular among retail investors. Stock options in particular. They can allow you to make leveraged bets on single stocks without much capital commitment. But they are not the same as Buffett's leverage, and they tend to be riskier and more expensive. Also, there was another nagging question that the authors of this paper wanted to explore. Specifically, was it Berkshire Hathaway holdings of public stocks or its holdings of private companies that contributed most to its performance? Based on their digging, they concluded that both helped them. So we may say that Warren Buffett and his team were both outstanding stock pickers and buyers of private companies. The next thing that the authors did was the most interesting. They tried to explain Buffett's alpha using some standard academic factors, and these factors included size, value, and momentum. I'm not going to go into too much detail on what each factor means, but suffice it to say that these standard academic factors, they failed to explain Buffett's alpha. So it's no wonder that Buffett's success has been such a mystery and attributed to some unique skill of his. But here's an innovation that authors came up with. They introduced two new factors. They are so-called bet against beta and quality factor. The bet against beta factor means going long on stocks with low beta and shorting stocks with high beta. Beta is a statistic that measures how volatile a given stock returns are in relation to the stock market. By definition, stock market returns have a beta of 1. Thus, a stock with a beta below 1 means that its returns are less volatile compared to the market. The authors also constructed a quality factor by weighing profitability, payouts, growth, and safety metrics. By safety, they mean lower risk of bankruptcy, low leverage, and other risk scores. When they took these two new factors, most of Buffett's alpha got explained. The authors concluded that there is no mystery behind Buffett's success. His focus on safe quality value stocks with leverage added were behind his success. Well, what if we meet Buffett for one of his $1 million lunches and ask him about betting against beta or other arcane statistical stuff? I think he will laugh at it. Academicians focus on explaining everything with something they can put a number behind. For Buffett, things are simple. As he said, whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Buffett's genius has to do with understanding value investing very early on. He picked it up and persisted with it for a very long time, despite ups and downs. Also, his use of leverage helped, but the leverage alone is not enough. He had to be right in his stock picks. As Warren Buffett pointed out himself, Ben Graham taught me 45 years ago that in investing it's not necessary to do extraordinary things to get extraordinary results. The authors went further and constructed a theoretical portfolio in a Buffett style that uses what they discovered. And this portfolio performed very well and comparably to Berkshire Hathaway. And so, to be fair, this is not just some abstract theoretical exercise. Many hedge funds and professionals use these models to generate alpha, and notably a famous and respectable hedge fund, AQR, was involved in this research. One of its principals, Andrew Frazzini, was a co-author on this paper. So no doubt there are wide applications of this research for sure. And that is it for this video. I hope it was helpful. I will link this research paper in the description. As always, thank you so much for watching. Like, share and subscribe for more. And I will see you next time. All the best.